Hi, and welcome to Business Successions Plannings and Exit Strategies. I'm Debbie Walpove, CEO of Merck's Payments, and today I'm so proud to introduce the dynamic duo, Casey Gosell. Casey is a partner at the law firm of Mandelbaum Barrett. Casey's practice focuses on a full range of business concerns, including startups, mergers and acquisitions, private equity placements, contracts, and corporate governance concerns. In addition, Casey, who has earned an LLM and in taxation, frequently guides business owners through the tax, estate planning, and wealth preservation issues that weave through their business as well as their personal lives. As a member of the firm's executive committee and director of the firm's charitable fund, Casey helps guide Mandelbaum's strategic growth and philanthropic activities. Outside the office, Casey is an active mother with two young daughters, Denali and Magnolia, and an avid athlete who's run 5 marathons, 30 half marathons, and numerous triathlons and Ironman events. Wow, Casey, you are an inspiration.
Thank you.
I also am so proud to introduce Andrea Diaz. Andrea Diaz is a partner at SKC CPAs. She specializes in working with entrepreneurs in all aspects of their business. She concentrates on developing strong relationships with her clients so she can fully understand their business model and how to keep them profitable, while also focusing on their growth strategies. Andrea ensures that clients' personal goals are in line with their business goals. She's a certified public accountant, holds numerous accolades and awards. She also has a master's in taxation from Rutgers University. Andrea is also a marathoner. She's an active participant in the Morris County Chamber of Commerce and very active in NJBIA. She's been the recipient of multiple awards and is frequently called on to speak to groups of business owners and contributor to various accounting and industry publications. In addition to all of this, Andrea serves on the board of Girls on the Run, New Jersey East. Ladies and gentlemen, I give you the dynamic duo of Andrea and Casey, who I'm proud to say are my lawyer and also my accountant.
Thank you, Debbie.
So today, as the title says, we're talking about business succession planning and exit strategies. Now, I am a solopreneur. I got into business working in the merchant services arena in 2008. At that time, I was working just for a friend. I signed a contract, and it was a great, wonderful relationship. I grew my book of business, and about 7 years into that relationship, the owner traded out to a larger corporation. At that time, I was dumbstruck, but I continued on my journey of working and getting clients in the merchant services arena. Working for a big company is different than working for a small company. Everything changed, but what was the same was my desire to make a difference in my clients' lives. What happened unexpectedly, which I was not prepared mentally or financially for, was a phone call came one day and said, "Good news, bad news. We're taking all your accounts in-house, but we will pay you according to your contract and your buyout." So many lessons learned about selling and buying a business. And what I have to say today is it's really important to lawyer up and have your finances in order with your accountant. Today, we're going to discuss several key tips for getting your acting gear and making sure you're prepared for that sale. So if I came to you today and I said, I wanted to sell my business, Andrea, Casey, what would you do to help me prepare? What can a seller do today to maximize her purchase price?
So thank you, Debbie. That was a wonderful intro, and we appreciate you. So first and foremost, financial due diligence. Get your financials in order. Clean, organized, updated through your most recent year end or quarter end. Normalize your profit and loss statement, which just means to add back any one-time revenue or expense items. So for example, what did most of us have in the last few years? PPP loans or grants from the government. We want to make sure that when we give financials to a potential buyer, we've specifically excluded those one-time items so that they're not included in calculations. Also, make sure that your state due diligence and that you're compliant in various states. So if you're doing business in more than one state, that could be in various capacities. You could be selling in that state, you could have employees in that state. And in this economy, or this market, I should say, everybody has employees somewhere else or contractors somewhere else. And you may not realize it. So you may just want to engage your accountant to see if you do have requirements in that particular state. When a buyer comes in to look at your financials and to make sure that you're compliant for all of your taxes, they will look at the various states. And again, if you don't know the answers to these questions, because it does become complicated, and make sure that you're talking to your accountant and your attorney. They can guide you as well.
Casey,
Yeah, I would say
you
on
have
the legal
anything to
side,
add? Oh,
yeah,
sorry.
I always have something to add.
I know you, that's why I said the dynamic duo. I can't do life and business without both of you.
So on the legal side, I would say that, the two biggest issues that come up when selling a company are HR issues and lease issues. So if you're going to be preparing your business for sale, whether it's 12 months from now, 6 months from now, 5 years from now, get your legal life in order. So that means if you've got people on the books that you're classifying as independent contractors, but legally they should actually be W-2 employees, fix it now. They'll make you fix it later, and it'll hurt you financially in the long run. If you've got some key employees that should have signed restrictive covenants, non-competes, non-solicitation, but you trust them, so it's all done on a handshake, put that in writing now. Your business will be valued higher if your goodwill is higher. And in order to get your goodwill higher, you need to have executed restrictive covenant agreements with key employees. On the leasing side, make sure that you've got options for renewal, because nobody wants to buy a business with a lease that's going to be ending in 12 months with no options to renew. It substantially devalues your business. And then just on the human element, I'll tell you a quick story. I had a client who had a deal. We were basically ready to close. Somebody on the legal side, on the buyer side, I was representing the seller. They decided to Google my client and found that he had actually had an incident that involved prostitution, that he thought it had been expunged, but it was on page 3 of Google, and they found it, and it killed the deal. So Google yourself now, run mean searches on your business now, Google your employees now, so that if there is anything from your past that, whether it's true or not, you have the opportunity to clean it up before somebody else finds it and brings it up.
Wow. I didn't think we'd have an example like that, but
It was shocking at the time. It was shocking for all of us.
I'm shocked right now. Great advice. Like I said, you really need to lawyer up and get your finances in order if you're even considering this. And I wasn't considering it, but it's important to do it today so you're ready for tomorrow. Another question. Would you change any recommendations that you just said if you were selling to an employee instead of an outside buyer?
I'll start. So The major difference between selling to an employee versus an outside third party is this ability to sort of transition over a period of time. So it really creates a lot more flexibility, both from a legal perspective and from a tax perspective, because you can do what's called an installment sale. So let's just say that you've got an employee who's maybe not necessarily ready to take over the business entirely. Maybe they're going to come on as a 20% partner, and then in a couple of years, they're going to become a 50-50 partner, and then eventually buy you out. You've essentially created your own succession plan, right? But what that does is it allows you to sort of do some on-the-job training for that person, transition your goodwill over a period of time. They pay you over a period of time, which in turn makes it so that you report the tax on that gain over a period of time. So while I still think it's important to prepare for the sale and get everything in order, because your employee is going to have an attorney who's going to want to review all those things, the transition is a lot slower, but it also makes it a little bit easier. Anything you want to add, Andrea?
Yeah, absolutely. No, I completely agree. When you have the availability to either say, I'm going to sell 100% today to an employee, and then what's called seller finance it, right? So you can then collect from that particular employee, or you can sell in tranches. I'm going to sell 10% this year and 10% next year and 10% the year after, and structure that. You have more flexibility to structure what works out for both the buyer and the seller in that instance. The one on a human level caveat to also be aware of is when you bring on an employee, you have to, as an owner, you have to think of the transition from employee to owner, right? So has that employee ever owned a business before? Do they understand the financials of a business? Do they understand do they have business savvy? So if you are bringing on an employee, I think you start sooner. From a training perspective, get them involved, show them the financials, show them what it means to be a business owner, so that they're not signing on the dotted line before ever understanding what goes into all that, the many hats that we wear as business owners. There's also the ability to do an employee stock ownership plan, which is simply just, it's an employee benefit that employees own the company, and it can over time, and it provides various tax advantages to the seller. Again, same concept, provides business continuity, retains employees, it's a fair market value price. So there are options to transition to employees of the business, maybe not just one, and still get better tax advantages.
I'm curious, would the purchase price be the same for an employee buying the company versus an outside buyer? What is your experience?
You want the lawyer answer? It depends.
That's very true. That's very true. I've had businesses, and I'm sure Casey has as well, where the employee has been in the business for multiple years. So they believe, and right, wrong, or indifferent, that they should get a better price versus an outside buyer because they've contributed to the growth and the increase in value since they became an employee, since they became, came on board.
Exactly. So generally speaking, a third-party buyer is going to be a higher purchase price.
Okay.
Usually.
We did get an answer from the lawyer. So the sales process, what does it look like? What should the seller expect? I know with my situation, it came out of left field. I already had a contract in existence, but the contract was signed when I was dealing with my friend. And so I know for me, everything happens for a reason. It was a great thing to wind up selling, rebranding. And then, after my non-solicit was up, came back and got my clients back. But there were so many lessons learned. And I think when you're talking about the sales process and what a seller should expect, it's really important, again, to start with your accountant and your lawyer and make sure contracts and everything are involved. Casey, what would you suggest is step one?
Well, I have to say, Debbie, your process was very abnormal. So that doesn't generally happen. Your process was like one step, right? But typically, I would say that the transaction process is essentially broken down into 4 steps. So you've got this step where you build your team, like you said. This is where you gather all the people that are important to you: your accountant, your attorney, if you're going to do a third-party valuation on your own business, if you have a broker, your financial advisor, anybody who's involved in the process for you. Even your estate planning attorney is somebody that you're going to want to get involved early in the process. Build your team, let them know what's going on. And at the same time that that's going on, you're usually negotiating your LOI. That's your letter of intent phase. Step 2 is more of due diligence. Step 3 is negotiating documents, and step 4 is closing. But just to sort of take them one at a time, I already talked about building your team. One other thing I would add there is, if you have somebody within your business that you feel comfortable confiding in them that this is going on, I highly recommend if you could have one ally. I know generally speaking, owners don't want to talk about the sale of their business with their employees, but once you have a signed LOI, you're going to get inundated with due diligence requests, and it's really, really difficult to keep up with the volume of requests and materials that you've got to supply if you're the only one doing it while also actively running your business. So whether it's your bookkeeper or, a CFO or somebody that you can help you with that, it's important if you can do it. And you want to talk about the LOI?
Yeah, so I think 100% making sure that your CFO is involved, because most of the documentation that you're going to provide to the buyer in the due diligence phase is financial. There are of course other aspects, but first and foremost, it's going to be all the financial information. So generally speaking, when the letter of intent is your first, hey, this is my offer, right? This is what I'm selling my company for. And it could come from the buyer side or the seller side. But number one, I think, aspect is, what is your business worth? Or generally, how much are you willing to sell your business for, versus how much the buyer is willing to pay for your business. Now, it's always subject at the LOI component. It's subject to due diligence requirements during the negotiation and purchase price phase. But if you're light years away at the LOI phase of, if you want $3 million for your business and your buyer's only willing to give you $1 million, you're too far apart. You have to get closer together, closer in that price component before going to all of the various stages, or you'll spend a lot of money on various professional fees and just not get anywhere. The other financial aspect to discuss during the initial phases, is it an asset sale or will it be a stock sale? So very high level, an asset sale are selling the assets of your business. You're going to sell your customer list, your inventory, your equipment, accounts receivable. When you're selling your stock, you're selling your actual LLC ownership interest or S Corp stock interest. They both are vastly different. They both have benefits. They both have, pros and cons to each. So you want to make sure that you're discussing the pros and cons for your particular business, and plan for it early on. So, we talk later about tax minimization strategies, and planning for either a stock sale or an asset sale much earlier in the phase. But those are the two financial components that I would say are two big key parts of the letter of intent that you want to make sure you're nailing down prior to.
And the LOI / building your team phase and the due diligence phase, which are two separate steps, they kind of get intermingled, because when a buyer first approaches you, they're going to ask for what we call initial due diligence, which is typically like 3 to 5 years worth of tax returns and financial statements, and not too much more. They use that information to then come up with a purchase price so that they can prepare your LOI. And once you've negotiated your LOI, or some people call it an offer letter, letter of intent, it's all the same thing, term sheet, doesn't really matter. But once you have that, then they give you the real due diligence request list, which is usually like 20 pages long and, very, very painful. And so, there's all different aspects of due diligence. We've been talking about financial, but there's also legal due diligence, where they're going to look at all your contracts, make sure you've got written employment agreements, written lease agreements, most important customers and vendor relationships, things like that. They look at insurance. I mean, every single aspect of your business is going to be covered by this due diligence phase. And the one thing I would add there is like, sometimes you just need to take a break and say, all right, like, this is part of the process. We call it deal fatigue. I mean, every single seller that we work with is at some point says like, I can't take it anymore. They'll ask you for the same thing 3 or 4 times. Just stick with it. You know, it all works out when you get your payday. So, so you'll have phase 1 and phase 2, and then you go into phase 3, which while the due diligence is still happening, the lawyers start drafting the documents, and every deal is a little bit different as far as like what kind of documents you're going to see, but you always have a purchase agreement, whether it's an asset purchase agreement or a stock purchase agreement. Usually if you're going to stay on for some kind of transition period, you'll have an employment agreement. You'll always have some kind of restrictive covenant agreement. If there's rollover equity involved, meaning you're not selling all of your company, you're going to retain some stock in the deal. There will also be an LLC agreement or a shareholders agreement, depending on the type of entity that you're going to end up with equity in. So all of these documents are being negotiated by the buyer's lawyer and the seller's lawyer at the same time as you're preparing all the due diligence. So these things kind of help happen in tandem so that you can eventually get to the closing, hopefully without, taking an entire year. People always ask me, like, how long does it take to close a deal?
I was just about to ask you.
Yeah, it's a very, very common question. A lot of times the closing date is set forth in your LOI. It's always longer than that. So don't plan your vacation around that. But I would say that the average deal takes anywhere from 60 to 120 days to close from the time the LOI is signed.
So it's like hiring a contractor to do renovations on your house when they tell you
Exactly.
3 months, plan for 6.
Exactly.
Yeah.
You got it.
And keep the champagne in the refrigerator.
Exactly.
Right. It will get open.
It will
Yes, it
eventually
will.
get open with you guys on the job, no doubt about it. But yes, that seems like so much. So in thinking about, tax planning when selling a business, by the time you sign a letter of intent, it's kind of too late to make changes, right? What should people be thinking of differently prior to?
So the best time to start for tax planning for a succession plan is probably 3 years beforehand, which sounds, sometimes it just doesn't happen. We don't have that availability. We don't have that time. But any time beforehand, a big one is state taxes. There are different strategies that you could potentially avoid state income tax altogether if you plan well in advance. There are certain state taxes that you may be able to pay through the business as a pass-through entity and get a federal tax deduction. So understanding preparing an analysis prior to the letter of intent of what would be beneficial for me. And if what's beneficial for me is not what the buyer wants, it provides a negotiating component. So, if it's better for you for a stock sale and you've already signed a letter of intent that has an asset sale in it, there isn't the negotiating room to adjust the purchase price for that benefit that the buyer is receiving and where you're taking a haircut. So of course, having that analysis, it all goes back to preparing and planning. You can, the best deals, the ones that have the highest purchase price and maximize net cash to the seller is planned long in advance of the letter of intent getting signed and the deal going through. So just the more that you plan for it, the better. The other component is retirement planning. So if you do have an asset deal, how can you shield some or all of your proceeds into tax deferred retirement vehicles to minimize your taxes. So again, just goes back to planning. And what I'll also say, go back to something that Casey mentioned earlier, rollover equity. Rollover equity, if structured properly, can defer gains on the portion that's rolled into the new company. So there are also ways that it gets structured where it doesn't defer the gains. So making sure that you have that component is structured if you are willing to stay on board and if you are going to be an owner in the new entity, that is also structured properly.
And Casey, would you make sure that your personal trusts, estates, wills are all in order?
Yeah, it all kind of goes hand in hand, right? Because presumably your net worth is substantially going to change. And so that may have an impact on the estate planning that was done for you in the past. You know, now all of a sudden you've got a liquid asset, and just making sure that you've maximized all the opportunities for estate and gift tax planning. I mean, it's an ever-changing climate with our code in the state of New Jersey, at least, which is where we all live. You know, a couple of years ago, we had a very, very low threshold on where estate tax started. Now we don't even have an estate tax. So it's always good to revisit those things, particularly when you have a major life change, and a sale of business is most definitely a major life event.
Sounds stressful, but sounds absolutely worth it.
I'll also add too, you know, if you're a current resident of New Jersey, or the tri-state area, or I'm just going to say a high income tax state, and you plan on selling the stock of your company and then moving to Florida, do it in reverse. Move to Florida first, then sell the stock of your company. It'll help.
Come on down. It's nice and warm in Florida. So I had an interesting situation. My purchase price was paid in one lump sum. My deal did not include an earnout, but I keep hearing about these earnouts. What's an earnout?
So an earnout, Deb, is actually a contingent component of the purchase price. So there's a lot of different ways that you can deliver consideration to a seller. Cash is always the most appreciated and most obvious one. But when you receive cash, you pay tax on it right away. Another thing is rollover equity, where you get stock in a company, which has got a deferred tax implication. And earnout is actually a contingent payment. So there's no guarantee that you're going to get anything. But what the buyer is actually trying to do is make sure that the value of the business continues for a certain period of time, and they're going to reward you for that. And it can be based on revenue, it can be based on EBITDA, it could be based on a lot of different things. But essentially the way it works is they're going to say, here is a threshold, and in, let's say, 12 months, if you hit this threshold, we're going to give you X amount of dollars more, or this percentage of that threshold. And it can be done in tranches. It can be done in a lump sum. Sometimes it's done at the 12-month mark, and again at the 24-month mark, but it's not guaranteed. So let's just say, for example, that you're selling a business that has $1 million in revenue on the day of the closing, and they may say, well, we'll give you an extra 5% of the purchase price if you can grow your revenue by 5% within the next 12 months. And so you get this payment at a later time. So an earnout, the way to think of it is like an earnout is a bonus that you may or may not get.
So it's important to continue to work and strive to get it, because
it's often used as an employee retention tool, because they want to make sure that the owner stays on for at least some transition period to really continue to ramp up the business and preserve the goodwill.
Yeah, that makes
and it's a negotiating point as well. I had a client who sold their business, and their earnout was based on gross profit. So they had to hit a certain GP dollar threshold as well as percentage. And when we looked at the agreement prior to him signing it, I said, you've never made this gross profit percentage ever. You know, it would be, this is what would have to happen in order to get there. So, and he realized it's kind of impossible in his industry to get to that gross profit percentage. So he said, I'm willing to sign for that gross profit number, but at a lower percentage. So, you know, there is flexibility there. And he did end up hitting it, which is great. And at least in year one, we're 1 year past that earnout mark. And he has a 3 years, you know, if he hits it in year one, it's X dollars, year 2, year 3. And so it could go on for much longer. And you also want to make sure that it's structured so that part of the earnout is capital gains versus ordinary income. There are certain structures where it could be taxed as ordinary income, as if it was compensation to you.
I see. Yes, that makes sense. My deal was taxed at capital gains, which was, you know, it's a huge tax savings. So it really makes sense. when you're selling to make sure that it's taxed at the right level. So talking about me again, my contract, I signed a 2-year non-solicit. That was part of my deal. So I couldn't really communicate and talk to my clients, but after the 2 years, I was able to then gain them back. And luckily, thank goodness, I had that kind of relationship with my clients that they did come back and utilize my services. But I know that there are several different types of restricted covenants. Casey, can you just touch upon the 4 that I think exist?
Yes, there are 4. Your deal was very unique, Deb, because you were actually not asked to sign a non-compete. So even though you sold your business, you were allowed to go out and create the exact same business and continue working in that market without restriction, except that you had to get all new clients. That's pretty abnormal. It's industry specific, but in almost every deal, there's going to be some kind of non-compete provision. So the 4 types of restrictive covenants are non-competition, non-solicitation, non-disparagement, and confidentiality. So everybody's got confidentiality. We go with non-disclosure because we keep it all 4 nons, right? But everybody's going to have a confidentiality provision. Anything that you knew about the business before the closing, you can't talk about it after the closing. That's the easy one. The second easiest is non-disparagement. Most lawyers include this. It basically says, I, buyer, promise not to say anything mean about you, seller, and you do the same for me. You're not going to go on social media and talk about how terrible I was or am. We both agree to play nice. And if we don't like each other, we certainly will keep it a secret. That's kind of what non-disparagement is. Non-solicitation has actually got 2 components. Typically, it will say you cannot solicit the employees of the business for a period of time. It'll also say that you can't solicit the customers of the business for a period of time. And that can range anywhere from 12 months to 5 years. The non-compete provision is the part that actually restricts you from operating a business of any kind that's competitive with the business that you sold. And that's usually limited to a geographic area. So let's just say that you are a manufacturer of computer mouse products and you only work in the state of New Jersey, your non-compete would probably say that you can't work and be involved in any business that manufactures these things within the state of New Jersey. As opposed to, let's just say that you make chapstick and you sell it across the country, your non-compete is going to say that you can't work across the entire country. So it's very specific to the business that you're selling. And there's always a term. People constantly ask this question: is a non-compete enforceable? The answer is, it depends. But in the sale of a business, a non-compete is always enforceable in every single state, even California. People think that they're not enforceable in California. It's not true. A non-compete against an employee is not enforceable in certain states. If you're selling your business, it's always going to be enforceable. And then the real question is whether or not it's reasonable. And so in the context of a sale of business, anything up to 5 years is usually considered reasonable. And the territory has to be somewhat related to the territory that you were selling before. So like I said, if you only sell in New Jersey, your non-compete should only be limited to New Jersey. If you're selling in multiple states or across the country, it can be broader.
Excellent.
Just going to say what's really funny is that all lawyers start their answer with "it depends," ... and all accountants start their answers with "generally," ... because there's never one answer.
Never.
No, there's so many variables, but that's why, again, we have the dynamic duo. And when thinking about the dynamic duo, the best piece of advice I also got when I was selling my company came from my financial planner. And Anj knows this, the creation of a defined benefits plan. So not only was I able to put some money away for my retirement, it was then sheltered and hopefully will be taxed at a lower rate when it comes out later in retirement. But, Anj, what advice would you give, or what have you heard over the years?
Yeah. And this is another instance where, Debbie, your deal was different than others because you were selling the assets of your company. You were selling your client list. You were maintaining your company, and you were still going to work in your industry and continue to work. So a defined benefit plan worked for you. And it was a great piece of advice. And now that you've continued your business and continued on, it continues to pay benefits year over year, tax benefits year over year. I would say it's hard to say what's your one piece of advice, because they're a little combined, but of course, making sure you have clean financials and getting a valuation expert who specializes in your industry. Your valuation, the top number or your purchase price, if you have a valuation from someone who understands the intricacies and the special benefits or the value of certain components of your business and can communicate that, generally your buyer is going to be someone who understands that value. But if the valuator is going to understand the market price and, what other industries, or I'm sorry, not industries, but what other purchasers are paying for your similar practice, you could get, 10 to 15% more on the top, on the purchase number by just having a very in tune valuation expert in your industry.
That's amazing. Great advice. Casey, do you have anything to add in advance of the sale? Wait.
My advice would actually be similar. Pick the right people. It's the thing that you do first, and it's the thing that has the biggest impact on the deal. If you try to get through this sales process with somebody who doesn't know what they're doing, you are going to struggle. You will be underrepresented. They will fail to negotiate the right points for you. So when you're going back to step one, where you're building your team, you pick your attorney, you pick your accountant, you pick your broker, your valuation expert, whoever's going to be on your team. Make sure that they know that your industry, they understand your industry and that they've done this before and that they're experts in this area. Because I can't tell you how often I'm on the buy side and the seller is represented by their brother-in-law who specializes in real estate and has never actually sold the company before. I mean, we roll right over those people. This
is not a time to DIY.
Yeah, this is not exactly. I love that. This is not a time to DIY.
What's the book? Dummies for selling your business. You don't get that book, and
Mergers and Acquisitions for Dummies. Yeah,
right?
You will lose more money in the long run. I promise you.
Absolutely.
So personally, when I sold my company, it was just me. I didn't have a succession plan. I was the sole owner of the business. If I was approached by a buyer, but unable to work or had given this more thought, what advice would you tell sole owners today who have no readily available succession planning?
Debbie, this is like one of the most challenging questions, because we have so many clients out there who are solo entrepreneurs. They might have a staff and, some people that they depend on, but certainly not, succession worthy. And it's like, what do I do? What if something happens to me before I create a succession plan, before I find a buyer? We've had to get creative over the years and think about some things. So I'll tell you a couple of different examples of what we've done. The easiest one is if you have an internal employee. If you have somebody, even if they're not quite ready, that you think that over a period of time could eventually take over the business. I mean, maybe it's a family member, maybe it's just somebody who's kind of got a proven track record of being loyal, and you think that they've got the ability to actually become the sole owner one day. That's the easiest one. You enter into some kind of partnership arrangement, you bring them on slowly over a period of time, and you create a partnership agreement that basically says that if anything ever happens to me, you're going to buy me out and my estate will get the money. And you can structure that so that it gets bank financing or paid over a period of time that makes it so that the business can still cash flow. But that's always the easiest. The harder part is where you don't have that person inside your business. I mean, maybe you have a booming business that you work from at home and there are no other people. What do you do? And so I'll give you two examples that I've had to actually execute on recently. In one of them, we actually found a neighboring business. They knew each other. They were competitors. They actually lived in the same town and serviced the same market, but they were both solo owners, and they entered into like a neighbor type buy-sell arrangement. So it basically said, I respect you, you respect me. We are going to always operate our businesses separately. But if either of us either becomes disabled or dies, we agree to buy the other person's company. And what they did is they funded it with buy-sell insurance. So they bought term policies on each other. And if anything ever happens, it hasn't happened yet, but if anything ever happens to one of them, they know that they've got a readily available buyer, because you're always afraid, right? If something happens to you, God forbid, and now all of a sudden your business isn't being operated, well, what's happening to your family? Like, there's no value there if the business shuts down while you go and look for a buyer for several months. So that gave them both the comfort. And I've actually done that model a few times, where you enter into this buy-sell arrangement with a neighboring competitor, friendly competitor. The other one that I did, and this guy, unfortunately, he actually passed away in December. So we've actually executed on this plan, and it's going very, very well. He came to me and he said, I'm never, ever, ever going to sell my business, and I'm never, ever, ever going to bring on a partner. What do I do? He was that kind of guy. What can I say? Great guy. Unfortunately, he died, and now we had to put this plan in place. And so what he did, and it worked out well, is we created bylaws for his company that actually said, in the event of my death, this person will become acting CEO. And for a period of 12 months, that person gets to make all of the decisions about my business, while he and my estate, his wife, who actually inherits the business and continues to be the owner, work together to interview and hire a permanent CEO for this 12-month interim period. And that basically made it so it was very clear that if this business eventually gets sold, the money does go to his wife, but he put this very capable person in control of running the business without actually giving them the business. As it turns out, it's working really well. We're about 5 months into the transition. They have been interviewing CEOs. I think the guy's going to end up becoming the permanent CEO. And I do believe that the woman who is now the owner of the business is probably going to end up selling him some portion of it, because she recognizes the value. But there's always a way to get creative. We just have to have a conversation and understand what your goals are.
That's amazing. I wish them well. I really do.
And in all aspects, you just want to make sure that life insurances are, you have the policies in place to sustain them, because it's far easier to, I'll say, sell your business on once you pass, if there's life insurance on you for somebody to use those funds to buy it.
Yeah. And it also keeps the business running, right? I mean, you need the cash flow.
Right.
Yeah. Again, another valuable partner in this whole thing, your insurance broker,
exactly,
financial planner, keep your network close to you. So now we have some questions from the audience, if it's okay. I just wanted to throw out a couple of questions. So Karen said, how to determine what my business value is worth, and where should I even begin?
So there are different valuations models. Some are based on industries. You can have a revenue-based formula or an EBITDA-based formula. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So it's an acronym. So it could be, a multiple of EBITDA, 4 times, 5 times. You can also have a market approach. So look at what other businesses in your same industry have sold for. It could be a component of gross profit, again, a multiple or a percentage of gross profit. Most times it's going to be formulaic based on, I'll call it the P&L component, your profit and loss component. So either a revenue component, a gross profit component, an EBITDA component. Those are all profit and loss statement components. There are other methods based on the balance sheet, right? So how much inventory and equipment that you have. Those are generally more liquidating values. When you're going to sell a business, it's going more often than not, it's going to be based on the business's ability to create cash flow, and how much and what is that cash flow worth over time.
And to continue to have
Sustain operations. Yes,
sustain
exactly.
operations. Yes.
So where would you begin to value it? You can certainly begin with if you wanted a back of the envelope, begin with your accountant. Most accountants do have some understanding. If they don't, you can hire an accountant to look over your profit and loss and provide you with a very simplistic view or number that doesn't go into detail, meaning it's not going to go into concentration of your customer list or where you're geographically located. It's simply going to look at your profit and loss statement and say you're earning X amount of revenue, and in your industry, it's getting X multiple. Very, very simplistic. Or you could hire, if you're at the point where you're ready to sell your business and this is your next step, you hire a valuation expert.
That makes sense.
Casey, anything to any other components there?
No,
I think you nailed it.
I do too. I think you're both nailing it. So one last question. How do you find a broker? Do I need a broker to sell a business? I mean, you hear about these business brokers all the time. I'm on so many networking things. I'm a business broker. What's a business broker? And do I need one? Do we need one?
It depends.
Generally.
So honestly, the answer is no. Okay. I get a lot of referrals from brokers. So we'll go with it depends, but no, of course not. I mean, plenty of people sell their business without brokers. What's really important to look at is how readily available is a buyer, right? Do you know potential buyers? Because there's a lot of different ways to sell your business. You were approached. You didn't need a broker. You didn't need to do anything. But if you're thinking about selling your business and you know that there are strategic buyers out there, there is nothing that prohibits you from going and asking them. I mean, you can approach that buyer. If you think that that's going to somehow give you some disadvantage, which maybe it will, go through your accountant or go through your lawyer or have somebody else who's like in the market make an introduction and make that connection for you. You'll save a ton of money on broker commissions. But if you are going to use a broker, I mean, it's pretty simple to find them. You can Google them all over, but Google it with your specific industry, because there's a lot of brokers out there that do general, and then there are brokers that are highly specialized in your area. And if you can use one that's highly specialized in your area, they're going to have connections to certain private equity firms and venture capital firms that offer higher multiples and are really coming after people in your industry. That's always the best approach. And the other question that I always get in connection with brokers is, do I just sign the commission agreement, or like, do I have any bargaining power? Yes, you do. Yes, you do. So most broker letters come out and they say you get 10% commission of everything. They throw in every piece of every component of the purchase price, 10% across the board. Usually, if I'm involved before they sign it, I can get it down to 6%. And I can carve out some of it, like carve out the earnout because it's not guaranteed. Make sure that they're excluding your employment compensation. There should be no commission paid on that. But generally speaking, as a seller, your broker commission will range anywhere from 5 to 10%, and it is in fact negotiable.
We have had some success with brokers. I had a client who, smaller business, under $1 million in gross revenue, more of a trade type business, didn't have a potential buyer and didn't know anybody who was going to buy his business. So he went through a broker and the broker found a buyer. So, certainly have had success. And Casey and I have actually worked on a deal together where we were on the buyer side through a broker. So, it was a great opportunity for our client to purchase a company, and we found it through a broker that was actually networking and saying, oh, I have this specific industry business for sale. And so it can certainly work. But generally, if you're looking to sell your business, you know who your competitors are and who's a potential purchaser. I'm sure most of you know who you have in mind prior to to even starting this path.
Oh. You guys have had so much success over the years. We really value your guidance today. I can't thank Casey Gosell from Mandelbaum Barrett, Andrea Diaz from SKC and Co. for your time, your insight, your experience, and your knowledge. It is so invaluable. If anyone from the audience would like to connect with us, Debbie Walpove, Merck's Payments, all of our information will be in the chat thread. Please reach out. We're all on LinkedIn. We're very connected. We look forward to serving all of you and helping make a difference in your sale process. Thank you so much.
Thanks, Debbie.
Thank you. Thank you both.